All attendees are in listen-only mode.
Welcome friends and traders, my name's Tian Crick and I'll be your host for today's UTP lesson on consolidation. And today is Thursday the 30th of March 2017. May I please confirm audio and visual? Do we have sound? Beautiful, beautiful. Thank you Mark, thank you Dennis, and thank you everybody else for joining, Elena. Right, now today I'm going to discuss small consolidation, breakouts, large consolidation, pivot points and pennants. Sideways market movement, which is also referred to as bracketing or pennanting, is considered consolidation. Consolidation is when the market prices begin to establish a trading range, creating close or equal levels of support and resistance on any time frame. Trading ranges are the distances between the highs of resistance and the lows of support in a chart for a certain time period. There can be trading ranges for an hour, a 4-hour time period, a day, a week, a month, or even a year. Trading ranges on charts are broken down into two types. First of all, a chart's trading range, which depends on the time period being considered. A chart's trading range is considered to be a large trading range. And then you get a time period trading range. It's looked at over a specific time, for instance over 3 hours. And this is considered a smaller trading range. So there's a chart, and on this chart you have the chart trading range, and then you also have a smaller trading range within that larger trading range. Right, so those are the two types of trading ranges, a chart trading range and then a time period trading range. Please type a Y or a yes if everybody's with me up to this point. Okay, good stuff, good stuff. Thank you, thank you, thank you. Now consolidation takes on four major forms. First of all, small consolidation. This is found on smaller time frames, such as the 15, 30, 60-minute and 2-hour charts. And they typically have a 20 to 40 pip trading range. Then you have large consolidation. This is usually found on 4-hour charts and above. For example, daily, weekly, and in a monthly chart. And they typically have 1,000 to 2,000 plus trading ranges. Then we have pivot points, and they are found on all time frames. Yet they are most effective when found on larger time frames. And then we get to pennants, and this is found on any time frame. Right, let's have a look at small consolidation. Once again, this is found on smaller time frames, such as the 15, 30, 60-minute and 2-hour charts, and they typically have 20 to 40 pip trading ranges. So here's consolidation in a downtrend. There's a time period trading range. Right, the market's moving down, but before it moves down, it consolidates before it moves down again. Here's consolidation in an uptrend. Market moves up, but it takes a breather at a certain time and then starts to consolidate before we see a breakout again. Now the four reasons the market consolidates on smaller time frames could be due to the fact that the daily trading range has been fulfilled or the market is entering the dead zone. Somebody earlier this morning asked an analyst on demand what would be the best times to trade. Best times to trade would be during the active zone, which is around about from 2 a.m. Eastern Standard to 11 a.m. Eastern Standard Time. Rest of the time the market may be consolidating because that's regarded as being in the dead zone. Secondly, prices have reached an equilibrium level where there's not enough trading volume to move the market. Third one is, prior to fundamental announcements, markets can become range-bound in anticipation of the announcement's release. Now, it's common in the hours after a significant fundamental announcement that once a market has moved beyond its daily trading range, prices may again settle into another consolidation range due to thin or light trading activity. Here's an example. Number one, the daily trading range has been fulfilled and the market is entering the dead zone. So there's the active zone. Market has moved, and then we're in the dead zone and then the market consolidates. Here's an example of where prices have reached an equilibrium level where there's not enough trading volume to move the market, and then it will also consolidate. Prior to fundamental announcements, markets can become range-bound in anticipation of the announcement's release, and it's common in the hours after a significant fundamental announcement that once a market has moved beyond its daily trading range, prices may again settle into another consolidation range due to thin or light trading activity. So there we have the market consolidating before an announcement. Then we get the announcement, the market breaks out, and then after the announcement, the market consolidates again. Now, what is a breakout? It's when prices move out of a consolidated trading channel in either an upward or downward direction. Breakouts take place usually after fundamental announcements. As a rule, breakouts also take place in the direction of the previous trend after the market has consolidated. There we go. Market will consolidate and then break out in the direction of the preceding trend. Market will consolidate and then break out in the direction of the preceding trend. Here's a few tips. If the market breaks out of consolidation and returns to the range beyond the middle of consolidation, it has a high percentage chance of going the other direction. Now, to give you an example, let's just take this out. This was yesterday's lesson. Euro NZD. There we go. We can clearly see that the market moved up. There we go. Market moved up. Then the market formed a consolidation range in the form of a pennant. Lower highs and higher lows over here. There's the range. The consolidation range. Resistance, 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 support, support, future support. Now going back to the manual says if the market breaks out of consolidation and returns to the range beyond the middle of the consolidation, it has a high percentage chance of going the other direction. So there we have it. There's the middle of this consolidation of the pennant. And look what happened. The market broke out of this range, broke out, but then came right back inside the range and moved below the middle. Now it's got a high percentage chance of actually going the other way. Is everybody with me up to this point? Does that make sense? Okay, great. Now there are times the market consolidates in front of a numerical or Fibonacci target. It breaks out of the consolidation, hits the target, and then goes in the direction of the underlying ABCD wave pattern. Consider placing your stop order at the low or the high of the consolidation range to be a stop reverse order. If the stop order is too far away and you can't afford the loss, then don't take the trade. Listen to the chart. The chart will tell you the majority of the time which direction the market is going to go. Do not marry a trade. Be quick to turn from a bull to a bear or from a bear to a bull. Strategize several scenarios before you trade. Use the if-then approach. Right, here we get to the first one. If the market breaks out of consolidation and returns back into consolidation beyond the middle of consolidation, it has a high percentage chance of going the other way. So there we can see the market consolidated, then broke out of consolidation, moved right back inside consolidation, and then moved the other way. You may want your stop order at the low or the high to be a stop reverse order. For instance, if you want to trade the breakout, if your stop is above the consolidation high and the market returns and stops you out, then immediately it should have triggered a buy order. That's a stop reverse order. If the stop order is too far away and you can't afford the loss, then don't trade. Now we get to large consolidation. These are found on 4-hour charts and above. For example, daily, weekly and monthly charts. They typically have 1,000 to 2,000 plus trading ranges. Here's a weekly chart. Large trading ranges or trading boundaries are found on monthly and weekly charts. If you consider the historical price movement of a given currency pair, the two countries involved in the currency cross you are considering generally prefer, as a matter of policy, to keep their currency inside a price range, which then becomes the trading range for that currency pair. So there you can see on the higher time frame, you have a trading range over here, right, with support and resistance. To give you an example, let's open up the euro dollar. Look at this. Can you see that the euro dollar is range bound between support and resistance? This is what is referred to as a large trading range, and that trading range is about 1,100 pips. Right. Market moves from support to resistance, then again from resistance to support, support to resistance to support, support to resistance, resistance to support again, and now we have bounced at support, and now we are going to move towards resistance again. There we go. Right, so that's a large trading range. Selling resistance and buying support in large trading ranges. On larger time frames, such as the 4-hour or greater, if you find consolidation, consider selling resistance and buying support. Right. For instance, if you want to sell resistance, wait for a bearish candlestick formation at resistance, and then you can look for a sell, or wait for a bullish candlestick formation at support, and then you can look for a buy. To give you an example, we do have a trading range on the Swiss yen, as far as I recall. Let's have a look at this one. Right, we might as well open up that one on a 4-hour chart so we can see the whole range. There we go. Support. And resistance. And this is the range. Type of wire, yes, if you can see the range over here. Look at that. Right, now, the only way to confirm that the market has indeed bounced at the consolidation support is to draw a downtrend line, wait for the market to break the downtrend line to the upside, and then you can look for a buy. Also, wait for a bullish candlestick formation. Look at that. We had a bullish morning star candlestick formation over here. There we go. Bearish decision candle, indecision, and then a bullish decision candle. Okay. So that's how you confirm a bounce at support or resistance with regards to consolidation. When considering a given currency pair to trade, it's recommended to find its monthly or weekly trading range. This enables one to define where the market is within its trading range. Knowing this will give you probability of future or continued market direction on smaller time frames. The market can develop a smaller trading range inside a larger trading range. So there's a larger trading range, and now we have a smaller trading range inside the larger trading range. To give you another example on that, the Aussie Canadian. Let's open up a monthly chart. There we go. That would be the range. Resistance and support. Right. Inside this large trading range, we can identify a smaller trading range. Resistance and support. There we go. So we have a smaller trading range within a larger trading range. So it's always important. I like to always identify the ranges. I love to trade from support to resistance and resistance to support. Right, does that make sense so far? Good stuff. Now we get to pivot points. Pivot points are found on all time frames, yet they are most effective when found on larger time frames. Forex pivot points are areas where the market creates a price level of support and resistance. If the market is below the pivot point price and the market returns to that level, that area in price becomes resistance and can be a level at which to sell. If the market is above that pivot point price and the market returns to that level, that area in price becomes support and may be a level to buy at. So there's your pivot. Right, if the market is above it, it will find support, and if the market is below it, it will find resistance. Just to give you an example of a couple of pivot points, let's have a look at this chart over here. Just have a close look at that level over there. Right? Would you agree that that's a pivot? If the market is above it, it's support. If the market is below it, it's resistance. 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 Look at that. Support. Resistance. Okay. Another example of a pivot, dollar yen. Look at this picture. Here we go. Can you see the pivot? support, resistance, support, 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 resistance, resistance, support, and then support again. Amazing how the market actually honors such a pivot level. Tom is asking, could you explain daily pivots versus weekly pivots and how they can be used in trading? Just use them as your next level of support or resistance, and if they form a confluence with a Fibonacci level, then it's a much more significant level where the market may U-turn, regardless if it's a monthly or a daily or a weekly pivot. Okay, what I do is when I do my analysis, oh, Tom, you are referring to a different type of pivot where it takes the previous candle and then looks at the midpoint of the high-low range of the high-low price of the previous candle. These pivots that I discuss here are not those kind of pivots there, Tom. All right, it's a different pivot. So if you have a look at the weekly, daily, monthly, weekly, and a daily chart, and maybe you're referring to target trading, huh? Right, let's have a look at the monthly. There's a pivot. Let's see where's another pivot. Looks like there's a pivot as well. 11176. Type of wire, yes. If you can clearly see that that's a pivot as well. 111, call it 11150. There. You agree that's a pivot, eh? Support. Support, support, resistance, resistance, support, resistance, and now support again. Okay? Right? Mark is asking, where's the pivot tool in the charting package? You can click on the smart tool at the top in the menu. Over here, there's the menu. Click over there. Then select the smart pivot line. Right. Personally, I don't like to use the smart pivot. The smart pivot has been developed for those traders who doesn't yet feel confident enough to establish their own pivots or identify their own pivots. So I don't use that. I manually look at the chart and then identify a pivot. Okay. But nevertheless, where we are at the moment, we all agree that we are converging with a pivot, hey, at 11150. So I'll link that pivot to the lower time frames. There we go. And for instance, if I get a trade here, let's say we have an up AB boundary like that, and the market is converging with a pivot, and I can see that that pivot is forming a confluence with a Fibonacci level. Can you see that it forms a confluence with a 382? Then I would regard that as a great place to look for a buy. That's how we use pivots in our trading. The market's above the pivot, that pivot could be acting as support, and it forms a confluence with a Fibonacci level. Good place to look for a buy. Does that answer your question? Okay, good stuff, good stuff. Right, let's carry on. Now we get to pennants. Now pennants are found on any time frame. Pennants are a form of consolidation. A pennant begins to form when the market begins to vibrate by bouncing off support and resistance. It can also move back and forth, typically in a Fibonacci sequence of A, B, C's without the market going to the D extension. Market prices tend to get tighter and tighter in consolidation, bouncing off of support and resistance trend lines until it breaks out of the range. Pennants may form when prices have reached levels at which market participants are not willing to buy or sell. Pennants usually form after there's been a big move on larger time frames or a breakout from a fundamental announcement on a smaller time frame. Pennants are found on all time frames. Pennants are a form of consolidation. Pennants create A, B, and C's with no D extensions. They move in a Fibonacci retracement sequence, getting tighter and tighter in their consolidation. So there we have an A, B, C, but no D. A, B, C, no D. A, B, C, the market doesn't move to the D extension. And slowly but surely, it moves tighter and tighter. It gets tighter and tighter. This resistance moves closer to the support. Right. To give you an idea of a pennant, the pound Swiss franc, we have a massive pennant over here. There we go. Look at the most recent market movement. Look at that picture. Can you visually see the pennant? Can you see that the market makes lower highs and higher lows? Look at this. We can use the pennant tool, the triangle pattern tool, to identify that pennant. And there it is. Here we go. And it will make ABCs without the market hitting the D. AB retraces to the 786, but the market doesn't move to the D extension. AB retraces to the between the 618 and the 786, market moves up but never hits the D extension. Right. AB, no D extension. All right. Does that make sense? Are we all on the same page here with regards to pennants? Can you clearly see the pennant? Okay, fantastic. So when you think you have spotted a pennant, if the pennant is on a larger time frame, draw your trend lines across the highs of resistance and the lows of support creating the pennant. Turn to a smaller time frame and buy support at the support line, at the uptrend line, or the Fibonacci 618 or the 786. And sell resistance at the downtrend line, or the Fibonacci 618 or the 786. Wait for candlestick formations on a smaller time frame to confirm that the market has indeed bounced at resistance or support. Here's an example. There's a weekly chart. If the pennant is on a larger time frame, draw your trend lines across the highs of resistance and the lows of support, creating the pennant. Turn to a smaller time frame. Buy support at the uptrend line, or the Fibonacci 618 or the 786, and sell resistance at the downtrend line, or the 618 or the 786. Wait for candlestick formations on a smaller time frame to confirm that the market has indeed bounced against resistance. Combine that with a trend line break as well. That's what I personally prefer to do, just to confirm. To give you an example, there's our pennant, right? Resistance, and there's support over there, right? If I want to buy over here, then I'm going to look for a bullish candlestick formation, and this candlestick formation over here is what we call a bullish engulfing candle. So there's a bullish engulfing candle, Excuse me, there was just a bee here in my office. Wow, it's still here. I'm allergic to bees. If you were with me now, you'd see me jumping up and down here. Okay, well, it looks like it's gone. All right, let's carry on. So there's a bullish engulfing candle. Combine that with a trend line break, and you have wonderful confirmation that the market has bounced at support. There we go. Okay. Are we all on the same page here? Please type a Y or a yes. Great. Now there are 4 types of pennants. First of all, we get a flagpole pennant. This is a pennant formation that usually breaks out in the direction of a previous trend. They can be considered both a bullish and a bearish pattern. Then we get an ascending pennant. This is a bullish pattern formation that usually breaks out bullish. The market makes equal highs and higher lows with each wave. Then you get a descending pennant. This is a bearish pennant formation that usually breaks out bearish. The market makes equal lows and lower highs with each wave. Then you get to a diamond pennant. This can be bullish or bearish. It starts off expanding and then contracting before you see the breakout. So here's a flagpole pennant. The market is moving in Fibonacci sequence, bouncing off support and resistance trend lines, getting tighter after each bounce. They can break out to the north or to the south, but have a tendency to break out in the direction of the previous trend. So there's a flagpole pennant. There we go. This is a pennant formation that usually breaks out in the direction of the previous trend, and they can be considered both bullish and bearish. Then you get to an ascending pennant, also known as an ascending triangle. The market creates equal levels of support or resistance and higher levels of support. So it's got higher lows, but it's got a flat top. And the breakouts on these pennants are usually to the north. Here's an example of an ascending pennant. We've got a flat top. There we go. And we've got higher lows. Then we get to a descending pennant. And the market creates equal levels of support and lower levels of resistance. So lower highs, but we have a flat bottom. The highs of resistance are descending, and the breakouts on these pennants are usually to the south, regardless if you find it in a bull or a bear trend. To give you an example, we had one of those on the pound New Zealand dollar. There's the flat bottom. Support, 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 and then we have lower highs, like that. And that is what we call a descending triangle or a descending pennant. You can draw it in with your triangle tool. Like that. Right. Can you see the descending triangle? Can you see the descending pennant? It's got a flat bottom and lower highs. Right. And this one will typically break out to the downside. Okay. Right, here's another example of a descending pennant. This is a bearish pennant formation that usually breaks out bearish. The market makes equal lows and lower highs with each wave. I would have drawn that one over there like that. There we go. Flat bottom. So in a bull trend, that will typically reverse the trend. In a bear trend, it will signal continuation. Then we get to diamond pennants. This is by far one of my most favorite patterns. The market expands first and then it contracts. So it forms a bit of a broadening formation and then starts to contract. And they can break out either way, but I've seen that they reverse. In my personal experience, they reverse a trend. Nice reversal pattern. Here's a diamond pennant. It starts off expanding and then contracting before we see the breakout. To give you an example, look at that. We can see that the trend was bearish, right? We had a downtrend. Trend is bearish. Then the market gave us a diamond formation. First it was expanding, but then it started to contract and eventually broke that diamond to the upside, and the whole trend is now reversed. So that is a fantastic reversal pattern. If you see that the bottom of a trend, you can expect reversal. If you see that one at the top of a bull trend, you can also expect reversal. So this whole trend changed direction. Okay, so there's your diamond. Right, a few traders tips. If the market breaks out of consolidation and returns into the pennant, it has a high percentage chance of going the other way. You may want your stop order at the low or the high to be a stop reverse order of the pennant. Check your equity management before you reverse your positions to avoid unnecessary additional losses. If the stop order is too far away and you can't afford the loss, then don't trade. Right, and that's now the end of our lesson on consolidation. Did you learn something today? Did you enjoy the lesson? Beautiful. Beautiful, beautiful, beautiful. Any questions? Pedro says, well explained, but the reality is harder. I agree with you, Pedro. But that's why you have us, to help you in the Analyst on Demand. Okay, everybody. If nobody's got any questions, thank you so much for joining me today in today's UTP lesson on consolidation. I'm glad you enjoyed the lesson. I'm going to take a break, and after the break, we'll see each other again in the Analyst on Demand. Tom says, any additional comments on the other pivots used with targets? No, not at all, Tom. That is entirely separate to the Ultimate Traders package that we focus on now. Okay. There's only one pivot we focus on, and that is the horizontal support resistance levels that we manually identify. Okay. Right, everybody. Have a great one. I'll see you back in the Analyst on Demand. Cheers.